In its latest results, AECI reported a 25% increase in its full-year headline earnings per share to 720 cents. The company increased its dividend by 33% to 179%, and the company's revenue is split between mining, agriculture, manufacturing, property, and fibres. AECI, what are your thoughts on this one? Now we're moving from pea shooters, toothpicks to a company of substance.
Bazooka-sized businesses, you know, howitzer-sized businesses. Okay, so this thing's got a market cap of about 12 billion. It's been around forever. You know, African Explosives was one of the first businesses that was founded on the Rand to support the mining industry. It's recovered quite nicely. It's got credible, high-profile management. It's looking good in terms of its core businesses, which are chemicals, which are explosives, detonators, all that kind of stuff. It's already worked out how to deal with the import issue because it makes some stuff over in China and it makes some stuff locally and so on. But for me, the additional kicker in the business is the property holdings, because as we know, they've got properties around their facilities like in Modderfontein, which are hugely valuable because they can develop, you know, Greenstone Mall and so on and so forth. That part of the business obviously has been a bit dead lately, but you know, the recovery cycle.
What are the chances that they're going to unbundle that property element of the business and realize the value for shareholders?
Well, I think management have stated often that it's non-core. They are on a evaluation process. Both the Modderfontein and the Somerset West properties are being valued at the moment. So, I mean, I think that it's a cherry on top, but it doesn't really add any kind of value to the core investment thesis.
In other words, Paul should not be excited about it. You were a little bit too enthusiastic about the property side. Now let's focus on the core business.
The property in this last year added about 13% to headline earnings, to give some kind of context.
13% to headline earnings. Do you own AECI in your fund?
Yes, we do.
Give me a better sales pitch on it.
Well, here's a company that's growing at about 25% per annum. It's trading on 13 times earnings. So it's, for a company this size, we think that's a reasonable kind of valuation to pay on that kind of growth metric. The exciting thing is, again, is exposed to mining. You know, if you like mining, but you don't really want to own a mine, it's risky owning a hole in the ground. Here's a great way to play the mining
into that mining environment.
This is a much lower risk way to play the mining theme. You know, it's got exposure to South America, Southeast Asia, and Africa, and so you've got a quite a good global diversification, you know, earning stream. But really, I think that you know, the long-term prospects for AECI are fantastic. You know, the explosives business is the core. It's about 50% of headline earnings. Specialty chemicals is about 32%. So really, it's, and again, you know, it's a distribution business. It's very scalable, very low risk, attractively priced, with some good secular earnings momentum.
AECI certainly sounds like an interesting story, but you've got to believe in the resource cycle if you're going to go into a company that's fortunes are directly correlated to the mining industry.
Yes, and I do. I am very confident about the mining industry globally. I know that it is fashionable in the last 7 days to be worried about China and so on and so forth. But I think
fashionable. They revised their growth target from 8%,
exactly,
where they've had it for 10 years, to 7.5%.
Which they've done for every 6 months for the last 16 years. So
another debate.
Leaving that aside, the fact is that AECI, and he says, are perfectly poised and all of that. The dividend is back, so that's a net positive. And overall, for me, I think we need to understand that the theory that we've been talking about earlier before the break was that you need to be small and you need to be unloved in order to generate shareholder gains. Because a stock like AECI is actively traded, so where's the bargain? You know, where's the opportunity?
You don't go for small unloved stocks, though. Whose philosophy are you talking about?
My theory is why you don't need to bother with those small unloved guys is that you overpay for the volatility in the stock, and that the gains you can make from these quality companies in a booming sector is precisely from the PE expansion. So the earnings will grow, and they may be boring in their growth. They won't like be 150% up than what they were last year. They'll manage a nice steady 25, but the sentiment will improve to such an extent that the share price will go from its, you know, 7 PE to its 15 PE, and you'll be rich.
Anthony, isn't he starting to irritate the hell out of you? You're not close enough to clap him over the ear, but
you know, the obvious point is this happened already. It's trading at 13 times earnings. It's hard to see it trading at 23 times earnings, but it's possible in another kind of mining, you know, equity boom. But yeah, again, I think that the risk return is in your favor in the stock, and there's some really good hedge.
Go back to what he was saying, though, that you can't go for those unloved stocks that are possibly going to re-rate. They're not worth looking at because they're so small. And you've got to go for something that makes up for the potential volatility that you're going to experience in the smaller stocks.
Well,
don't you feel quite passionately that you should look at those small stocks for the potential upsides that they could give you?
Absolutely. The evidence is there. We bought Ralph's at 80 cents. It's trading at R3.50 now, and over 18 months. So that is phenomenal returns.
80 cents, R3.50.
The evidence globally, when you talk small caps, is that more of them fail than succeed. More of them get nuked and end up being zero gainers and small caps. So I understand that he's done well of late, but I don't think you can extrapolate that every punter out there at night watching the show ought to make up their stock portfolio of these kinds of shares, hoping that amongst the fallen angels are a couple of
are Rolfs and
stories.
Winhold fly-by-night stocks?
Absolutely not. I mean, I think that you can add real value as a boutique asset manager if you're prepared to go out and see these companies and spend time with management and go back multiple times and get to know the companies well. And that's how we think we can justify our management fee, by doing the hard work and doing the hard yards.
How do you justify your management fee? You don't do any hard work.
No.
You just go with whatever's running.
No. We focus on sectors we like, and we hold stocks for like 15 or 20 years but we hold quality so that you don't have to buy and sell them the whole time. But we've got a small amount of time left. I'm interested to hear Anthony's hot stock and to put my biggest, hottest
hot
stock
or not
on the table.
on AECI?
Hot.
Hot. AECI.
Yes, I'd go with hot.
Thank
Enough.
goodness, one hot from you tonight. We're getting somewhere.